They love it when you're generous. Well, if you provide housing for lots of people, they're going to give you more benefit than if you just provide housing for yourself.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, chef, the father of six, the best-selling author, the G-Daddy, Gino Barbo. Gino, how's it going?
Mr. Stenziano, I am excited today. We got the whiteboard out. We're going to get some teaching going on. We've got an expert
I thought he was about to say the
in
whiteboard.
the house.
We're getting the whiteboard. Okay. All right, here we go. Today's guest is Tom Wheelwright. Tom is a CPA. He's the CEO of Wealthability and the best-selling author of Tax-Free Wealth. Tom is best known for making taxes fun. All right, we'll see about that one, and easy and understandable. He specializes in helping entrepreneurs and investors build wealth through practical and strategic ways that permanently, that's what we like to say, kill those suckers, reduce taxes. So without further ado, Tom, welcome to the show.
Thanks. Always good to be here with you guys. Love it.
We love to bring it. So my question for you, before I turn it over to the G-Daddy here, is why is real estate investing such a powerful tool when creating generational wealth?
One word, leverage. Leverage. The reason real estate's so good is because you get leverage in a number of ways. You get leverage through debt, but you also get to leverage your tax benefits. And it's the leveraging the tax benefits that, for a lot of people, the biggest returns they get in the early years are going to be the tax benefits. So this just comes with a lot of leverage.
We heard that yesterday, Gino, with one of our coaches, Colin Schwartz. And I'd like to add to that, you're creating a business, and it also allows you to leverage your time through your employees, which is a fantastic resource.
I was going to say people, bro. That's for sure. Because people think about a 4-unit and 8-unit, but when you have 60 or 70 units, all of a sudden you're hiring a maintenance person. All of a sudden you're hiring a manager. So you're leveraging all of that. So that's awesome. Jake jumped right past one of my favorite parts is I want to hear your story, Tom. I mean, how did you get into becoming a CPA of all things, making it exciting, becoming a rich dad advisor, all that? I mean, give us the story. Give us a background.
My heavens. Well, so real quick, I grew up in Salt Lake City, Utah, which is the heart of Mormonism. That's what it's known for. I grew up a good Mormon boy.
And sales.
And hey, I spent 2 years in Paris, France, learning how to accept rejection. That's what I did. It's an amazing 2 years of being, having doors slammed in your face. And first week, somebody slugged me, knocked me down. That's, if you can take that, pretty much you can take anything. So that was really a great start to a career. And then I started at the University of Utah, got my bachelor's of accounting from the University of Utah, and then went on to the University of Texas to get my master's of tax. I spent 7 years with Ernst & Young, one of the largest CPA firms in the world, and 3 years in their national tax office. In fact, 1986, I was there when they passed the major tax reform in 1986. So I was doing a lot of teaching, creating courses for CPAs around the country. And I left there, came to Phoenix to run the real estate tax practice for them. Was here for a couple of years and then decided to go into private industry and went to a Fortune 1000 company as their in-house tax advisor. And from there and then I went to another large CPA firm and it didn't work well for us. So after 7 months, they figured out before I did, they fired me. So it was time to do what I really wanted to do, which was, be in business. And so I started my own CPA firm. I actually started with 2 clients and was so successful after 9 months, doubled my entire firm. I had 4.
Wow.
So I'm probably one of the few of not only CPAs who's ever cold called. And I did cold calling for 9 months and then realized that you can actually buy a CPA firm. And I had a friend bring a CPA firm to me and offered to finance it for me. So that was 25 years ago. And since then, I was an adjunct professor in the Masters of Tax program at ASU, Arizona State University, for 14 years. And I broke up with a partner about 20 years ago. And when I broke up with the partner, half the clients left, but all the staff stayed. So you'll understand why I broke up with that partner. And when you have all that staff stay, you need more work. because you don't want to lose staff, right? Because you train staff, and they're an important part of what you do. So I was looking for a CPA firm, and I ended up buying a CPA firm, one of the clients of which was Mr. Robert Kiyosaki.
Uh-huh.
Oh, very nice.
And that's actually how I got to know Robert. Is I didn't go through the usual channels. I bought him. So we, eventually we got to know each other, and it actually about 10 years ago we started traveling a lot together. And I remember the day we're in Las Vegas at the Paris, and he says, "So tell us about taxes." And I said, "Well, taxes are really just a series of incentives for business owners and investors." And I could just see the light go on. You know, that great look you get in people when the light goes on?
Yes.
And he goes, "Really?" And from then on, we were traveling all over the world. And, he got, because what we teach actually supports what he teaches a lot.
Mm-hmm.
Because he's teaching, go to the B and the I quadrants, right? Get out of the E and the S quadrants. And when you look at taxes, they support that.
Mm-hmm.
So the tax law actually, the big business owners get more tax benefits than the small business owners. The professional real estate investors get many more tax benefits than the casual investors.
Mm-hmm.
And so I know, for example, in real estate, obviously, and something that we always talk about when we talk about real estate, we talk about real estate professional, right? Well, that's I quadrant, right? That's a professional investor. That's not casual E quadrant stuff,
Mm-hmm.
or even S quadrant stuff. It's really I quadrant. And so, when you get those big tax benefits, follow also the money. What's really been interesting is to discover that the more, if you make money the right way, and if you make money through assets instead of earnings, okay, the more assets you buy, the less taxes you pay.
Mm-hmm.
So it's like completely opposite. So, people wonder why the rich are getting richer. Well, that's why, because one of the reasons is that the tax law favors them, because everything they do, what the rich people are doing things to benefit the economy, to grow a business, to develop real estate, develop energy. When they do that, the government says, look, we not only are we happy with you doing it, we want you to do that, and we'll incentivize you to do that. So we give you tax benefits for doing it, whether it's, for example, an energy tax credit, or whether it's, you to put solar on your house, right? You get an energy
Mm-hmm.
tax credit. If you want to invest in oil and gas, you get big deductions for oil and gas. They want you to invest in real estate, they give you big deductions for depreciation on real estate. So whatever it is that the government wants done, they pretty much tend to do it through the tax law. I mean, even if you look at the recent stimulus packages, the CARES Act, and the new one that they're proposing, most of what they're proposing happens through the tax law, right? The $1,200 checks happen through the tax law. That was a tax-based incentive.
Mm-hmm.
So, people think that taxes are like bad or evil, or people think, well, you know what, I need to pay my taxes, and I have to pay my taxes. You do. You have to pay what the government wants you to pay, but you can change your fact pattern so that you can pay less if that's what you want to do.
I love that. So you had said in our first meeting, it's all about stimulating behavior. I want everyone to write that down. Taxes are passed and are written to stimulate a person's behavior. So cost segregation, you want more money to flow into multifamily, because multifamily investors are creating housing that the government cannot provide. The government can guide. I've seen single resident occupants in Harlem. I see what the government tries to do with housing. They cannot provide the housing. So how do they do that? They want the money to flow to that. So if you want to expand upon that, Tom, that'd be great.
Well, yeah. So let's go to what the average person sees, right? Mm-hmm. The average person sees, okay, they'd like you to adopt children. They give you an adoption credit. They want you to send your kids to college. They give you a credit for sending your kids to college, right? They want you to buy a house. They give you a deduction for interest. People don't get a deduction for rent, but they get a deduction for interest. Well, what does that tell you? That tells you that the government would rather you own a house than rent. That's what they're saying. Now, on the other hand, if you provide housing for other people, now that's what the government would really like. So they give you much bigger tax benefits. They don't just give you the interest deduction, they give you the deduction for the entire building and property and everything you put into it. So, really one of the ways to look at it is, the more generous you are, the less taxes you pay, because we all know that you get a tax deduction for charitable donations, right? I mean, everybody knows that. And in fact, if you donate appreciated property, like appreciated stock, you get a deduction for the fair market value of the stock, and you don't have to pick up the gain in your income. So it's like a double benefit, right? So the government loves, they love it when you're generous. Well, if you provide housing for lots of people, they're going to give you more benefit than if you just provide housing for yourself. If you provide employment for a lot of people, they give you more tax benefits than if you just provide employment for yourself. So the more people you can help, the more people you can serve in the economy or in housing or in energy or whatever, the more stimulus the government gives, because they want, as you said, they want to stimulate that behavior pattern. And you just have to say, am I willing to change my behavior to get that stimulus? And if I'm willing to change my behavior, the government says, great. You know, the government doesn't, look, we're partners with the government, right? Everybody knows that when they see their paycheck and they get, you know, the government's taking 30% out or 40% out, right? Oh, I've got a silent partner here, right? Only not so silent, right? So the government doesn't care. They actually don't care. Either you pay a lot of tax, which they're happy to take the money, or you do what they want you to do and you partner in a more active way. So it's like you can be a silent limited partner, or you can be an active general partner, right, with the government. And if you're an active general partner, they're going, oh, well, then we'll give you, instead of you paying tax, what we'll get from you is we'll get behavior that we want, and we'll get stimulus of the economy, and we'll get stimulus of technology, and we'll get charitable, right? We'll get all these things that the government wants to have happen, okay? But they don't care. The government's agnostic, right? They don't care if you pay a lot of tax or if you follow and do what they tell you to do and pay less tax. They're the same either way.
You know, we know the people listening to this show are folks that change their behavior, like you touched on. They're folks that educate themselves and they want to grow wealth. What is it with the rest? I mean, you talk about the 99% and the 1%. What is it with the rest of society that they choose not to change or educate themselves? Because look, this stuff isn't rocket science. I started off as a pharmaceutical rep. Gino started off as a chef. And now we have over $100 million in real estate. What is lacking from the folks that choose not to take action and educate themselves?
All right, so let's go to Robert's Cash Flow Quadrant, right? Second book, after Rich Dad, Poor Dad. He says there's 4 ways, right, to make serious money as an employee, self-employed, big business, or professional investor. So over here, as an employee, what people, there's a fear here. And what they do is they fear, they actually fear control, okay? They fear having to take control over their situation. They'd like somebody else to tell them what to do.
Is it responsibility?
I think it's just, you know what? I don't want to have to make a decision. I mean, why would you ever invest in a mutual fund? I don't want to have to make a decision, right? I'm going to let the mutual fund people make the decision for me. You know, so I'm actually in fear of being in charge, right? And the S people, they actually fear no control, right? So they want to have control over everything, right? They want to have control over everything. These people over here, the big difference is these people have faith in people. And these people have faith in the market. Right? So it's just it's a fear-faith type of thing, right? Are you operating out of fear? Or are you operating out of hope and faith, right? And there's a lot of faith over here that, look, I'm going to trust that my 500 employees will take care of things. I don't have to be in control, right? I fear control down here. Up here, I don't have to be in control, right? Over here, you know, over here, they're afraid of the market. They're afraid of taking charge, and they're afraid of what goes on in the market. Well, these people over here, when you talk about your $100 million of real estate, you had faith in the market. You had faith, this is what will happen. If I do this, the market will do that, right? And so you had confidence in the market, faith or confidence that you had confidence in yourself, right? Once you learned how to do it, but you also had confidence that the market would behave the way your education told you it would behave.
Mm-hmm. I think, Tom, also, for me at least, it had a lot to do with ego, and not being ego, but the S quadrant is I need to control everything because no one can do it better than me.
Right.
And it's I'm a mentality. In the beginning, Jake and I started that. I'm going to do this, I'm going to do that. But as you get more confidence and as you learn how to create a business, that was our journey, Jake. We went from 25 units to 1,600 units, and we had a lot of different inflection points. And during those inflection points, we saw that if we want to create multiple streams of businesses, like we have an education company, we have a syndication company, a property management company, we have the investments. If we didn't have the faith in the people and the faith in ourselves to say there are people better than us, that's a real tough journey. And to answer Jake's question, I think a lot of people have to have that self-awareness and have to say, you know what, I'm not the best at everything, and it's okay. I'm not supposed to be.
Yeah, it's really hard. I don't think it's a little hard to go from here to here. Okay. But a lot of people are willing to do it because they want to own their job.
Yep.
Right. But to go from here to here or here to here is really hard because you're completely changing do it yourself, right? If you want to get done right, you got to do it yourself. To guess what? There are other people who can do it better than I can, or other people can do it almost as well as I can, and that's good enough. Okay, because again, it's leverage, right? Yep. This is all leverage over here. There's no leverage over here.
Tom, you've had a lot of successful clients, I'm assuming, that went from the S to the B, the I. For me, specifically, I'll give you like the 20-second for me. I just had enough pain, right? I was building someone else's dream in the S quadrant, and I was working with my dad at the restaurant, and I had this revelation a few weeks ago, and I really got choked up about it. I opened the restaurant with him, and it was sort of like his dream, and I was living with him, and I loved it. And then when he passed away, that sort of dream evaporated, and I wanted to create a real business. I wanted to employ people. I wanted to empower people. I wanted to enrich people. I wanted to be around people who are smarter than me and more amazing than me, and I couldn't do that in the S quadrant. So I just found Jake, and I went to the B quadrant. Can you have a couple examples or stories of people that you've worked with that have gone from the S to the B and say, wow, this is, what hit them? For me, it was just basically, I was fed up with my situation. I wanted to change.
Well, I'll tell you a quick story about myself. When I started my accounting firm, within a couple of years, I was up to 10, 12 people. And I remember having a friend come up to me at a conference, and they said, how did you grow so fast? How did you I don't understand how you do this. And I said, well, I never started out with the intention of being small. That was never my goal. Okay. My goal, you start out with this, it depends on what are you trying to achieve, right? I mean, for example, right now, we actually sold a big CPA firm so that we could actually expand, right? Because we were here. And what we want to do was we want to be over here so that we could help more people, right? Buckminster Fuller, the genius of the 20th century, said that the more people you serve, the more effective you become, right? And so now we have a network of CPAs, and we're building that network. And our goal is fairly sizable. I mean, we literally want to be known as the premier tax reduction system in the world. Right. And we're going to do that not through our own employees, but through other people and their employees. Right. I'm not good at running a large organization. Okay. But I'm really good at helping a lot of people run their own smaller organizations. So to me, the way I'm going to get here, it's kind of like Robert Kiyosaki. Right. So Robert gets over here. I know he's not real popular in a lot of the news press right now. But
he's fine within our community.
But Robert over, the way Robert does this is he doesn't have a whole lot of employees. He has a lot of relationships with other companies that have a whole lot of employees. Okay, so you don't have to have, it doesn't have to be your own employees. That's my point. And so there's a number of ways to get from here to here, right? If you're not, if that's not your dream and your skill set to own a really big business, but if your dream is still to serve thousands and hundreds of thousands and millions of people, you can still do it through relationships. This idea that they have to be employees is like a really old idea. right? I mean, independent contractors, other companies, relationships with people like you, right? I mean, we have Wealthability, we have lots of relationships with a lot of people who just know a lot of people, right? And they're better at certain things than we are. So we let them do those things, right? We don't have to do it ourselves. We don't have to become an expert in technology. We don't have to become an expert in marketing. We don't have to become an expert. We can be experts in what we're experts in, okay? And then just have the relationships to go over there. So I see that with a lot of people. You know, it's, to me, a lot of going from here to here is that relationship. You know, it's a faith in relationships, whether it's your employees, your partners. Somebody asked me once, I was doing this mastermind group, and this guy said, man, I just would never have a partner. I just can't imagine having a partner. It was just, I've had a partner and it was the worst experience of my life. And I'm like, I can't imagine not having a partner. Okay. And my first partner was a terrible partner. I mean, my very first partner in business turned out to be a terrible partner. I mean, he was okay at first, but then as we grew, he didn't grow with it. So he turned out to be a terrible partner. But what did I do? The minute that he left, I took one of my key employees and made them a partner. Why? Because there are things in my mind that I can do with a partner, because then I don't have to worry about that part of things. Right? Because I can have complete trust. I mean, you guys are partners, right? So you can have trust in what the other person does that is not what you do, right? And so you're really leveraging, like you say, you're not just leveraging other people and their time, but you're leveraging their talents and their skills and their relationships. And so it's just leverage upon leverage upon leverage. You know, it's compounding leverage, which we actually call velocity at Wealthability. And that's why we're happy to help other CPA firms. We offered to the first CPA firm we talked to, we said, well, you should join our network. And their response was literally, why would I share what I know with somebody else? And I'm going, why wouldn't you want to learn what other people know?
That's great.
Yeah, it's right. What point of view are you coming from? Are you coming from this fear side?
Scarcity
I'm
mindset.
afraid somebody's going to take something from me, or are you going from this generosity side? Let me give more, and if I give more, I'll probably get more, but it doesn't matter because all I want to do is give more, right? I mean, you come from a mission, right? This is what, and when I look at people who've gone over here, I see people who are very mission driven. They're not money driven. That's what's interesting, is I've never seen anybody get over here who was money driven. Not once. These people are very money driven. These people are very
tool, right, Tom?
These people are very money driven.
Yes.
They're very much about money. Okay. A number of years ago, I moved my family, and we moved 4 blocks. And the reason we moved 4 blocks is I actually wanted to move from this group of people to this group of people, just because these people still didn't care as much about money as these did, because they had money, right? Because these people tend to have more money than these people, right? So they had money, so they didn't care as much about money. These people, it's very much, I find very much, it's a mission driven.
And it's funny because it's the abundance versus scarcity mindset.
Totally.
I think the people on the B&I are working for their sole purpose. They're working for money. I heard a quote. Jake and I were talking yesterday. The person who only has money is poor. If that's all you have is money, you're basically living in poverty. And I think for us, everybody out there, think of your mission statement. Tom is talking about your mission statement and your core values. Right. If you have those, that's how you start creating a business. And that's when Jake and I started taking off and we're able to build other businesses. And that's why I want everyone to look at our 4 phases of financial freedom. Because once you become financially free and your passive income exceeds your expenses, all of a sudden you don't have to worry about money. Money is not the central topic. You can actually start creating businesses and start helping others. And like Tom said, the more people you help, ironically enough, the more money you make. It's not really supposed to work that way, but it really is. And it's just everything.
And the fewer taxes you pay. That's what's really shocking.
Yeah. So I love that, the tax reduction system. When I'm out there, Tom, how do I hire a really good tax reduction specialist? What am I looking for in a Tom Wheelwright?
Just call Tom. Everyone we talk to says he's the best. So.
I want to know what makes Tom the best, though.
In chapter 23 of Tax Free Wealth, okay, my best-selling book, Actually, I actually go through what you need to do to find a good tax advisor. I had this conversation with Kiyosaki when I was writing the book, because he said, would you put in there the 10 questions you should ask when you're interviewing an accountant? I said, yeah, I can do that. I said, but that's not how you find a good CPA. And he says, what are you talking about? I said, well, the advisor's job is to ask you questions. It's not your job to ask questions. It's your job to give the answers. It's like you go to a doctor, it's not your job to ask the doctor questions. Okay. It's the doctor's job to diagnose what's going on. And so the doctor says, where does it hurt? How, is it a sharp pain? Is it a chronic pain? How long have you had this? Right? You spend 15 minutes with the doctor, 14 minutes is them asking you questions, diagnosing. Okay. But you go to most accountants and attorneys, and of that 1 hour you spend with them, 55 minutes is them telling you how great they are. Right? And why you should work with them. Okay. What they should be doing is asking you questions. Okay. So tell me, if I were interviewing an accountant, okay, I would say, I would want the accountant to ask questions like, so tell me about your business. Tell me about, what are you trying to accomplish here? What's your time frame for accomplishing? What do you, even to the point of, are you planning to give all your money away before you die? Or do you want to leave a legacy for your children? Or what is it you want to do? Because when you look at taxes, you can't look at them in a bubble or in a single transaction. You cannot do that. If you do that, you will lose. Okay. If you do that, you'll lose. You have to look at it as a whole, as an entire picture, which includes relationships with your family. Because your kids actually have something you want. They have tax brackets and you'd like their tax brackets. So why aren't you using their tax brackets? Right. So, your relationship with your family, how does your family talk about money? What do you want to do? What kind of legacy do you want to leave when you die? What are your charitable intentions, if you have any at all? What are you trying to build here? Are you, what would be, we talk about passive income. Remember, you play the cash flow game, Robert and Kim Kiyosaki's cash flow game. And what's the goal? The goal is to have more, like you just said, more passive income than expenses. Well, you can do that one of two ways. You can have a lot of passive income, right? Or you can have really low expenses. But you have to choose which one you're going to have. So, you can start with, let's have real low expenses. Great. You can get out of the rat race pretty easy if you have really low expenses. I mean, let's say you're spending $3,000 a month on expenses. You only need $3,500 a month in passive income and you're out, right? You're financially free. So for me, I'd rather be financially free at a really high level, right? I don't want to spend less money. I want to have more money so that I don't have to worry about my expenses. That's kind of but that's me personally.
That's that impact piece too. You're able to make a much larger impact at that level.
Well, you can. And the reality is that, they say that one of the challenges we've had during this crisis is rich people not spending money. It's actually,
you can't go anywhere.
My dry cleaner, she's struggling because her clientele are high-end clientele and most of their clothes are travel clothes. Well, nobody's traveling. So she is only open 1 day a week now. Okay. And I feel bad for her.
But Tom, don't say trickle down. Right? Just saying.
Tom,
you don't say that.
It's actually, you do actually affect the economy more when you spend more money in the economy, of course.
Absolutely.
But the question is, how are you spending it, right? If you're consuming it, by the way, so this is a big tax principle. If you consume, you're going to pay tax. If you reinvest, you won't pay tax. It's that simple. And it doesn't matter where you reinvest. You can reinvest in your business. You can reinvest in real estate. You can reinvest in energy. You can reinvest in agriculture. As long as you're reinvesting the way the tax law works now, since 2017, as long as you're reinvesting, you're not paying tax. The minute you consume, you're going to pay tax.
Guys, that's really important. Two
Cash
principles.
Got to flow, baby.
Number one, Tom said it's the long game. Think of it as a long game. Number two, it is a holistic, all-encompassing plan,
Right.
whether it's for your wealth, whether it's for your health, whether it's for your family, whether it's for your taxes. Look long game, and it doesn't fit everyone's strategy. If someone else might have a different strategy. For me, $3,000 a month doesn't even pay my grocery bill with 6 kids. So, I mean, that would be like, I'd be on poverty row if it was for that. So, and the other important thing that Tom just said, I really want you to write this down. If you consume, you're going to pay taxes. If you reinvest, you're going to save taxes. So be a producer instead of a consumer. Right. I think that's what the ultimate entrepreneur wants to do. I'm not thinking about going out buy my next car. I'm thinking about producing my next video or writing my next book or doing my next podcast. That's what
complex.
Entrepreneurs are always. I got ADD. Me and Jake have the ADD of producing instead of consuming, and then out of that we can consume and not feel guilty because we're not. That's
at our leisure, right?
Have you been mystified like I have as how people say I have so much time I don't know what to do with it during this crisis? I'm going.
I've been busier than ever because we had to recreate our business.
I've never been so busy in my life. I've never done so many interviews. I've never done so many podcasts. I've never done so much writing. I don't understand. I mean, when you're in a crisis, you need to do more, not less. I can't comprehend it, but I think it's just the entrepreneurial mindset. We tend to think, okay, what more do we do? And how are we going to do it differently? Because now we have to change what we're doing.
Well, Tom, for us, it was really a problem that gave us an opportunity. We had virtual leasing. That's one thing. We had to create a COVID task force for our entire company. We actually didn't have virtual leasing was always a priority. And Jake likes to say it was in our garage or our parking lot. And it kept getting pushed until all of a sudden it happened. March 15th.
We had to drop the hammer.
Business,
It accelerated
and
it.
we
That's
did it.
great.
And it's amazing. Jake and Gino didn't do it. Big shout out to Chelsea, who really ran the team. And she did an amazing job. And we've got a lot of leases coming through. And that's something that's going to pull through forever. So I agree with you 100%. If you haven't been busy, you better start getting busy.
And if you haven't been working on yourself, if you've been furloughed and you've been at home, shame on you. This was your opportunity and you missed it. So
Well, and here's the other thing I'm thinking. I'm going, we've never had so many people online, right? Ever in the history of the world. If so many people have been online. All I think is that many more customers. That's that many more prospects. How is it? Why wouldn't you start a business? It doesn't cost anything to start a business anymore. It's literally free to start a business. Plus you get tax benefits if you start a business. You know, I was on a TV interview just the other day, and we were talking about home office, right? And they said, well, if I'm home and, because I can't go to work, I get to write off my home office. I said, no, you don't. Not if you're an employee. If you're a business owner, you get to write off your home office. If you're an employee, you don't. So why not? So why aren't you starting a business? You're furloughed. Start a business. This is like a prime opportunity to start a business. And whether it's an investing business or, an e-commerce business, whatever it is, why wouldn't you do that?
I love that. Before we get to the short answers, I was wondering if you could really give a high-level overview of cost segregation. Let's say I am a GP or I'm raising capital, and I want to explain macro accelerated cost recovery system. I want you to actually elicit my croc brain and make it easy for me to understand and make me excited about it, because it's not really an exciting topic unless you figure out, like, holy crap, I'm not paying taxes with this.
Well, let me show you just how fun this is. Okay, you want fun? This is fun.
Yeah,
let's go.
Okay, and it's easy. Okay, so when you buy a piece of property, just consider what you're buying. Right? You buy land. Right? You buy a building. You buy the land improvements like the landscaping and the fencing and the covered parking, all that kind of stuff, and then you buy the contents of the building. Right.
So Jake better make sure that they got the landscaping down tight, because all Jake does is complain about guys who are cutting grass and not doing a good job.
I don't complain. I just fire him if it's not the way I like it.
So.
Okay. So now what the IRS, the tax law treats these four differently. Okay. Each one's different. Okay. Land, they go, well, it never wears out, so we're not going to give you any deduction. So the deduction for land is 0%. Okay. Even the IRS understands that land doesn't wear out. Building, they say it wears out, but it wears out over a pretty long period of time. So if it's a residential, they say it's going to wear out over about 30 years. So it's about turns out to be about 3.6%. Okay. That's how much you get to deduct every year as a proportion of the building. Land improvements, they say, well, those last a little longer. They typically last, 10 to 15 years. So that tends to be somewhere between 5 to 10%. And then the contents of the building, like the carpet and the ceiling fans and the window coverings, that kind of stuff, cabinets, they don't last very long at all. So typically they're going to be 5 to 7 years, so about 20%, right? Now, here's what a cost segregation does. A cost segregation just breaks down your purchase between how much of your purchase is allocated, what percentage goes to land, building, land improvements, and contents. That's what a cost segregation does. Now, here's the magic. 2017 changed the law. This now, instead of 5 to 10% or 20%, is now 100% in the first year.
Mm-hmm.
So let me give you a simple example. Let's say that you look at these and you go, okay, how much of my property is land? Let's say it's 20%. Okay. How much of my property is building? Let's say it's about 50%. Okay. These are pretty typical numbers.
Mm-hmm.
Land improvements, you're typically talking about somewhere around 10%, and then contents typically around 20%. Well, what does that mean? That means 30% of your purchase price is a deduction in the year you buy the property. Okay, so let's put this in perspective.
30%, Jake. I see Jake smiling there. So
okay, so
$10 million deal.
Let's put this. Okay, let's do your $10 million deal. How much are you putting down in a $10 million deal?
30%. We'll be conservative.
Okay,
on this one,
so you're going to put down $3 million, right? Let's use your down payment, and then the bank is going to put in 7, right?
Mm-hmm.
For a total of 10 million. Right? Now the bank doesn't get any deduction for its contribution. It's just lending the money, it gets interest, that's it. You're, however, going to do a cost segregation, and you're going to take somewhere between 20 to 30%, let's say it's 30, of that $10 million, and you're going to deduct $3 million, or in this case, the amount that you put down, you're going to deduct that in the very first year.
Tom, that's what they call making it rain.
If you're in a 40% tax bracket, that's $1.2 million you just put in your pocket from the government, because that's $1.2 million you didn't have to pay to the government.
Here's the key to life, folks. Get into a state that does not have income tax, low property taxes, nice sunny weather, and do some cost segs on some big buildings, and life is good. That's my playbook to life. Marry a good woman and you're good.
Is that what I've done? I've got the woman, I've got the kids, I'm living in Florida, I'm doing cost segs.
There you go. There you go.
Look, we don't gotta make this too difficult. Hire Tom to take care of the rest of it for you and your money. So
you got the whole thing. I mean, obviously there's details and all that kind of stuff. That's why you need good professionals, good team members to do that. And this is, you don't guess at this. That's a mistake, right? The IRS won't allow that. But if you have a professional cost segregation, I mean, you think about that. The cost segregation on this probably runs $20,000 to get a $1.2 million tax benefit. That's a pretty decent return on investment.
Why don't people do it? Because we've bought from mom and pops that don't do cost segs sometimes. What is the rationale?
They don't trust the government. That's one of the responses we got.
It's an engineered study, so you need to do an engineered study.
Here's the thing. How many people step over dollars to pick up pennies? They do it all the time. And that's a lot of what goes on. Well, this is expensive. It cost me $20,000 to do that for a $1.2 million benefit.
Mm-hmm.
And if you're a real estate professional.
So let me show you. The difference is, one of the differences over here in this cash flow quadrant is when people in the E and the S quadrant tend to look at money they spend as an expense.
Mm-hmm.
It's gone. People in the B and the I quadrant tend to look at money they spend as an investment.
Mm-hmm.
Okay, so if you're thinking of it as an investment, then you want to spend, and you're getting a good rate of return, you want to spend more money because you want to invest more money, right? If you look at it as an expense, you're trying to reduce your expenses. Okay, so again, scarcity and abundance, like you were saying, scarcity and abundance, but at the same time, it's also, is it an expense or is it an investment? Mm-hmm. And if you look at your team members and people around you as investments, why wouldn't you do this? Now, the other problem is that, of course, you have unfortunately, a lot of accountants who don't understand this. They go, well, that's really aggressive. I'm going, so just so everybody understands, cost segregations are required by the law. Cost segregations are required by the law. The IRS says if you don't do one, we won't punish you, because they're happy to get their money, or they're happy to get their money, right?
Mm-hmm.
But they are required under the law. Okay, there's no question. Under the law, they're required. So people think, well, that's aggressive, when in fact, it's conservative to do a cost segregation, and it would actually be aggressive to not do one. If you're saying, am I following the law versus not following the law, being aggressive versus not aggressive.
Mm-hmm.
So, people don't understand. And the other part is that, we, again, expense versus investment, your tax advisor, is it an expense or an investment? If your tax advisor isn't producing revenue for you, like tax savings, then it's an expense, and you want to reduce that expense. If your tax advisor is producing revenue, you want to spend more and more money with your tax advisor, and you want the most expensive tax advisor that's providing the benefit.
Mm-hmm.
Why would you not spend the money if you can get that kind of a return?
Gino, what does our buddy Josh say? If it makes you money, it costs you nothing.
There you go. There you go.
So I think that's what Tom's saying right
Absolutely, it's
now.
free.
Yeah.
Mm-hmm.
All right, guys, let's
Absolutely.
take a quick timeout to hear from our sponsor.
Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of.
All right, we are back. What I've been, dying to ask you this question, Tom, because I think you're a very insightful guy. What opportunities should business leaders be taking advantage of for the remainder of 2020? It's been a crazy year. What are you saying from, we're getting to, by the time this comes out, it'll probably be the 4th of July. What opportunities should folks be taking advantage of?
Well, first of all, remember that the CARES Act had some very significant tax benefits the only people who are talking about it are those who are complaining about them, right? You don't hear anybody talking about them and saying, look, this is an incentive, right? And we're incentivizing. We're trying to put cash back in the marketplace. So let me just note some of those important ones. Okay. First one is charity. So charity typically has been limited to 60% of your income. Now it's 100% for this year. So you can give up to 100% of your income. I think that's a great incentive. Okay. You want to give more money, give more money. A big one in your industry, okay, is the qualified improvement property, right? And what this is this is basically, you think of it, if you're in the commercial real estate, as a tenant improvements, okay? Tenant improvements, under the 2017 law, there was a mistake made, and everybody acknowledged it was a mistake, but it was in the law. And we had to deduct them over 39 years, commercial buildings. They changed it retroactively. Now it's 15 years. Well, guess what? If it's 15 years, it's 100% because it qualifies for bonus depreciation.
Mm-hmm.
So you can actually go back and get a refund from 2018. You can actually take this in 2019, or you could take it in 2020. You've got choices here, okay? Here's another one. Another one is the $500,000 limit, okay, loss limit. So what this was is that, let's say you did that $3 million cost segregation, right? And you had a bunch of income that was not business income. So you had interest and dividends and so forth. You could only offset $500,000 of that. That $500,000 limit went away in the CARES Act, okay? So there's no limit anymore. Well, why is that important? It's important because of the other thing they did, which they allowed an NOL carryback for 5 years. So think about this. Let's say you had tenant improvements, you did a cost segregation, you ended up with a loss. That loss, no longer limited, I can carry back 5 years. So I actually go back to 2018. I might end up with a loss in 2018, which I can carry back to 2013 when I was making a bunch of money before I got into real estate, right? So now I've got this real estate losses in 2018, 19, or 20, and I can carry those back 5 years and get money back. So now this one, by the way, the House in their stimulus package proposal that they passed, that has not passed the Senate yet, they would substantially eliminate this. Okay, so this is something you ought to do right now. This is something to do right this minute. Because they're going to pass the stimulus package in July. Pretty clear they're going to pass the stimulus package in July. When they do, that could go away. Okay, so take advantage of that right now. The other one that's also, I think, very important in real estate is the $100,000 IRA. Benefit. And basically what this says is that if you had to reduce your hours, either as an employee, because the government had shut down your employment, okay, you were non-essential worker. It's terrible word. Everybody's essential.
It really
Are you
is.
kidding me? Okay, so if you were non-essential, I was just glad that accountants are essential, right? They finally recognized that we're essential.
That's how they get paid.
If your business reduced its hours, or you're as an employee, you reduce your hours, you can pull out up to $100,000 out of your IRA or 401k with no penalty, no tax for 3 years, and roll it back into your IRA 3 years from now and never pay tax on it. You get a 3-year interest-free loan from your IRA, basically. Okay, or you can pay tax, but you pay tax a third this year, a third next year, and a third the following year. Okay, so you can spread it out. So you got huge benefits. Now, it's really restrictive. Okay, it only applies to certain people. But you know as well as I do that investing in real estate through your IRA, not always, in fact, rarely a good thing. Right? Rarely a good thing. You lose all the tax benefits if you invest in an IRA. You have potential tax consequences in an IRA because of the debt financed income. So there's a lot of bad reasons to invest in the IRA, but pulling the money out of the IRA, especially if you can do it under these circumstances, is fantastic. Okay, you just need to make sure you qualify and make sure that, go sit down with your tax advisor, make sure you qualify, you meet the tests. But that is a terrific opportunity if you got money stuck in an IRA, 401k, pension plan, private sharing plan, whatever, and you can pull out $100,000.
I love
This
that.
is why it's so important to get your team right, because you may be missing out on this kind of stuff if you do not have the right team. That's fantastic. On the personal side of things, what is your best habit for success? Something that you maybe do, every morning or on a weekly basis that's helped grow your companies and lead your prosperity?
I love my mornings. Every morning I get up and I do some personal reading, and I exercise every morning. I'm a swimmer. I have a 25-meter pool in my backyard. So
That's how you do it, right?
I literally, I do. I swam this morning before we got on here. To me, having personal time before you start the day is it's really important. I mean, I get up early to begin with. I mean, if I'm up after 5 o'clock, I'm like sleeping in, right? That's sleeping in past 5 o'clock. But I like that time. I like to have that hour where I can read, I can study. My wife and I have coffee together. We get a little together time there. It's quiet. Right now, my grandkids come over every day because they're part of our pod. And so they come over every single day. So that's great. But time in the morning allows me time to think about things. And the swimming actually, I was reading a quote, I think it's from Marcus Aurelius, about taking a walk. Sometimes you just got to take a walk. Well, for me, that's swimming, right? That's when your best thoughts come out, is when you're, doing some physical activity that doesn't require a lot of thought.
Mm-hmm.
to it.
Any books that you've read recently that you'd like to recommend?
You know, I'm reading this one right now that is one of my favorite books ever. You know, Ryan Holiday, the writer who wrote The Ego is the Enemy, and several other terrific books. Well, he wrote this book that is about, it's 366 Stoic sayings, the Stoics, from like Marcus Aurelius, Epictetus, you know, these guys that they wrote back in the, you know, 2,000 years ago. And it's just a daily read. So it's, and I'm trying to remember the name of it, but Ryan Holiday. Okay. So he's a terrific young author. I think he's one of the great authors actually of our time right now. So that's a really good one I'm reading. I'm reading an old book at the same time. I'm reading a book on positioning, called Positioning. It was written in the 80s, and a terrific book on positioning your business and positioning where you are and so forth. But, you know, there's classics. I mean, I think we sometimes forget that, you know, there are authors that were even thousands of years ago that have, you know, things don't change that much.
Mm-hmm.
And that, you know, whether it's ancient Rome, you know, with Marcus Aurelius, who I think was, you know, one of the great emperors of Rome, or Epictetus, you know, who was one of his teachers. You know, there's these great people that we forget to read those. And we're so focused on what are we, you know, who's writing something today, that we forget some of the old, I love some of that classic stuff. Mm-hmm.
Yeah, no, it's interesting because as, you know, some things unfold in society, we may not be getting stronger. We may need to look to the past for some of the answers. So that's fantastic. What project are you excited about right now?
Oh, I'm most excited about our network. So we have like I said, a network of CPAs. We just started it 2 years ago. We literally started from scratch. We just invited, it was funny. I said, well, let's see. We had people who called us and said, how do I learn to do what you're doing? And so he said, well, let's just invite 4 or 5 of them and we'll kind of explore something. And then I said, you know what? No, let's not do that. We'll just do a seminar. And so we'll just teach for 2.5 days about how to run your CPA practice, your accounting practice. And we had about 30 people come. You know, a lot of those were friends and family and stuff like that, right? You just barely making it that first time. And, but we started with a core of members. I mean, you know, 5 or 6 people signed up right off the bat to be members. It was a handshake deal, which is always rewarding when you can do a handshake deal, because we didn't have contracts or anything, right? We just said, this is what we're thinking. What do you think? And they all said, we're in, right? And since then, we've grown to over 40 members. Across the country. And our goal by the end of this year is 100 members. And so basically what we're doing is we're changing the behavior. We're working to change the behavior of our profession, right? So transforming a profession is really the project, is to transform the CPA profession. So that it won't be that difficult. You'll be able to just say, well, I just want a Wealthability tax advisor. And if you get a Wealthability tax advisor, you're going to know that it's going to be high quality client service. They're going to know what they're talking about. They're going to be up to date on the tax laws. They're going to be well trained. They're going to have all of that. Even though they're independent, you're just going to know, I can trust because they have Wealthability below their name. So that's the project. Once we get through, once we get to 1,000 members in the US, we'll go worldwide.
Nice.
So
I love that.
So what's the next step? If folks want to reach out or speak to someone from your team, what's the best way to do that?
Really simple. Just go to wealthability.com. So actually I have it right here.
So this is for the folks on YouTube.
That's right. Here we go. Wealthability.com. And you can schedule a call. Okay. And by the way, schedule a call if you want to, if you want to work with a Wealthability network member, call us and we'll get you to the right place. Okay. But what we really want to do is we want to get you through our proven process for tax reduction, because it's not about, this is the big mistake. In fact, let me ask you, you've got a lot of employees now, right?
Mm-hmm.
About 55. Yep.
Okay. So you have 55 employees. You do want to hire the right employees, but having the systems in place for those employees, which is more important?
I put systems on that.
It's systems, isn't it? It's the system that makes it work. You can plug the employees in, but if if you go back to Enron, what was their big mistake? They hired the best and the brightest, and that was their big mistake because they didn't have the systems in place, right? So they relied on the best and brightest to just take care of things. That's a mistake. So don't be looking for a CPA. What you want to be looking for is the CPA that has the process, okay? And that's what we've developed. We've developed a process for reducing taxes. So it's what our members get and what they deliver is that process. So if you said, well, give me the name of a member, I could give it to you, but they're not going to be able to do what we do because they have to, you need to go through the process. Okay. And it's that process that makes it work. So
the well-oiled machine, right, Tom?
It's, you know what, we've been doing this for a long time. I mean, I've been in this business for 40 years. So I've been, we've been tinkering with it and developing it, and we're getting better at it all the time. And I mean, we have clients. I mean, I have a doctor client that 3 years ago, he was paying $700,000 in tax, and this year he'll pay less than $100,000.
I hope his wife is a real estate professional and he invests
She is
in
not.
apartments. Oh, he's
She
even
is
better.
not. So this is the other thing, okay? It's great if you can be, but you don't have to be. Okay, and that's a big mistake. I actually heard you asked about why people don't do cost segregations. I talked to a CPA because I have clients who invest with the CPA's client, right? They invested in some multifamily housing projects with the CPA's client. I said, how come the loss is so low? I said, well, we don't do cost segregations. I said, why don't you do cost segregations? Well, because our investors can't use it. I said, your clients may not be able to use it, but my clients can. Okay, so don't you dare not do a cost segregation. I will not send my clients to you if you don't do a cost segregation, period. I will not
follow the law.
I will not refer, just as a matter of principle, I will not refer clients to a real estate syndicator who doesn't do cost segregation, because you're losing out on a huge tax benefit, because we know how to get them the tax benefit. Just because a lot of CPAs say, well, it's passive, you can't get this, doesn't mean that you can't get it. It just means you got the wrong CPA. So wealthability.com. We have a weekly report. It's free, so you're welcome to sign up for that. If you want more information or schedule a call, if you want to talk to one of our advisors, or you say you love your CPA, but they need to learn this stuff, get your CPA in here and have them call us, okay? Or a lot of our members have come from their clients. Their clients have said, nice. Look, I read this book, Tax-Free Wealth, and you need to call these guys, right? You need to call these guys. And they do, and they end up being members. I had just the other day, I was talking to one of our newest members. That's how she came to us, because her client had said, you need to do this.
Mm-hmm.
That's so cool.
Love that.
Gino, any closing remarks?
Yes. Jake, picture this. Young Tom Wheelwright has a baguette in one hand and an espresso in the other in Paris. He's getting punched. He's using the baguette to hit that person, right? After 2 years, he says, I'm done with this. I'm going back to Utah. Gets a degree in Utah. And then he goes to Texas and gets his master's. In 1986, he goes to Ernst & Young for 7 years. What a journey, right? Going from an employee to an employer. He's cold calling people. He's like, this sucks. I went from 2 clients in 9 months. I had 4 clients now. I'm really not doing well.
Blowing up.
What is the secret? And like Tom, like most other amazing entrepreneurs, he commits and then he figures it out. And he goes and buys other practices and he continues to grow. And by luck, right? Because Tom isn't working hard. He's working super hard. There's no such thing as luck. It's really hard work. He meets Robert Kiyosaki through a client, through a practice that he bought. And he continues to grow and he continues to get smarter and he continues to commit. And all these things that Tom said throughout this podcast, I want everyone to write these down because I wrote so many notes. Long game. Being holistic with your taxes. Taxes stimulate behavior. That's why we write these taxes. Think about that, everybody. You can control how much taxes you pay. It's all about responsibility. If you consume, you pay. If you reinvest, you pay less. The more generous you are, the less taxes you pay, right? The more people you can help, the more stimulus you're going to get, right? I mean, I had so many notes over here, and I love this one, right?
Tom, you got to grade him on this. Is this an A+ or what?
He's doing awesome. Gino, I'm impressed.
So you spend money as an expense. That is what the E and the S quadrant is. You spend money as an investment. When you're investing in your education, or you're investing in your business, or you're investing in a tax advisor like Tom, that's not an expense. That's really an investment, because you're getting an ROI. You're getting a return on your investment. So I would challenge everybody who's listening to this, really go back and listen to this again and really take notes and dive down deep, because what Tom's talking about is personal responsibility, educating yourself, and getting the right team members on board, and not being able to, as Jake says, get rid of them if they aren't doing the right job. Because this is a really important topic, because we're having class warfare right now. We're having the rich and the poor, and you can become rich because the laws are written. All you need to do, as Robert Kiyosaki says, follow those laws, learn what those laws are. And the only way you're going to do that is by finding a Tom Wheelwright out there who will help you. So, Jake, anything else from you?
No, I just want to say it's been an honor to be on with both of you. A ton of knowledge, and I appreciate both of you. And thank you so much for your time, Tom.
Tom, thanks for coming on today. I appreciate it.
Thank you. And by the way, the book is The Daily Stoic. So
The Daily Stoic.
Daily
Write
Stoic.
that
We'll
down.
get that.
The Daily Stoic. Okay. Thanks for having me on, guys.
Thanks,
Thanks,
everybody.